Well, hey everybody, I'm Mike Gasior, and welcome to my March video commentary. And if you can imagine it, this is March 1st. And I like winter probably more than almost anybody, but you know what? Enough already. I'm hoping I can show you one of these video commentaries from someplace with palm trees soon. But anyway, as promised, this month's commentary is about preferred stocks, which I find truthfully preferred stocks get a bad rap as basically the investment of choice for widows and orphans. But in the last decade, and I wrote this in my last newsletter, preferred stocks have evolved a lot and are not what, your grandmother used to remember. But let me just start with the very beginning and the basics. What's preferred about preferred stock? Well, basically, in contrast to common stock, preferred stock is preferential in every way. The common shareholders can't get any dividends unless the preferred shareholders have gotten their dividends already. There's one preference. In the event of a liquidation, should the corporation that issued the stock go bankrupt, the preferred shareholders are in line ahead of the common shareholders. But as much as I'm making these comparisons right here to common stock, the truth of the matter is preferred stock actually compares much more closely to bonds, especially for the corporation doing the issuing. Because for the corporation, the choice isn't, do we issue common stock or do we issue preferred stock? The choice is, do we issue bonds or preferred stock? And in my classes, when I'm teaching, I'll even ask my groups, which one do you think the corporation should prefer? And a lot of times, they'll answer preferred stock. And there are two reasons for the answer. Number one, preferred stock is issued from the equity side of the balance sheet, so it doesn't show up as debt, which is kind of nice. Secondarily, preferred stock, which might sometimes be callable, which means the corporation has the right to call it away from you as the investor and retire the preferred stock. There very often is no maturity date that just sort of overhangs the corporation with the worry that they're going to have to pay that debt back. And while those are advantages, here's one huge disadvantage. Most of you probably know when a business borrows money from a bank, by issuing bonds, whatever, interest that they pay on that debt is always deductible as a business expense. Dividends on common or preferred stock is never deductible. So there's a big disadvantage, huge disadvantage, number one. The other thing is, while the preferred shareholders are preferential compared to the common shareholders, the preferred stockholders are still behind the bondholders, which means the preferred shareholder is going to demand a higher rate of return than the bondholder would have expected. So in those two regards, deductibility of the interest and the fact that the bonds will probably pay a lower rate is going to drive most corporations to choose the bonds over the preferred stocks. And preferred stocks, price-wise, are more closely tied to movements in the bond market than anything else. Because most typically a preferred stock is issued with either a fixed dividend or an adjustable rate attached to it. And just to give you a real simple example, not even maybe 10 years ago, a corporation might have issued a preferred stock at $20 and had a $2 dividend attached to it, which is easy math. That would have represented a 10% yield for the investors. Now, if I've been holding that stock until now clearly rates are much lower now. If I were to sell it to a new investor, well, they don't deserve 10%. I mean, I did back when I bought it. But let's say these new investors, they only deserve 5% return yield. Well, my stock, I'm going to have to sell it to them for $40 with the $2 dividend to represent a 5% yield. It's the drop in interest rates that drove that preferred stock higher. So very much like the bond market, bond prices move opposite of interest rates, which is a discussion for next month. There is, I'm not leaving it out, if the credit situation, if the situation at the corporation begins to deteriorate or get better, that will impact preferred stock prices, not nearly as much though as interest rates will. Now, let me just give you the one wrinkle. I wrote it in my most recent newsletter, too. There's been some innovations. The most probably dramatic is the advent of money market preferred stocks, or you might even hear the initials thrown around, MMP, or if you want the full name, 49-day Dutch auction money market preferred stocks. And this is where things really began to change a lot. If you talked to me back in college and you told me about some investment that was about 2 months in length, you had a fixed rate for the 2 months, but then the rate was going to reset and you had to make the decision whether or not you wanted to reinvest, well, I would have told you that was a fixed income. Sounds like a CD to me. But that's what these money market preferred stocks are. They're absolutely technically a preferred stock. But here's the thing. you get a rate attached to it, an interest rate attached to it that you're going to earn at that interest rate, which is going to be fixed for 49 days, 7 weeks. At the end of the 49 days, they're going to reset the interest rate, and you have the decision, and this is the Dutch auction part. They're going to reset the rate, and you decide right then and there, do you keep your money invested, or do you want your money back? And if you leave it invested, basically you're just rolling the money over, and you'll keep it in for another 49 days. This, if you talk to an institutional, money management desk, it's most likely going to be the short-term investors that are going to, the short-term traders are going to be making that investment. And the vast majority of short-term investments tend to be fixed income. That's why it gets so confusing sometimes for the people that have to do the accounting, administration, and so on, because here's just a few insights into this 49-day thing, because it seems pretty goofy. In the United States, the Internal Revenue Service has a rule that when one corporation invests in the stock of another corporation, the dividends they receive on that stock, common or preferred, is 85% tax-free. So as long as one corporation is buying this money market preferred I described, the dividend is going to be 85% tax-free. It's fantastic. However, to qualify for the 85% dividend exclusion rule, you have to hold the stock for 45 days. So the 49 days was a fairly easy choice. It's an even 7 weeks. It has 4 days more than the 45-day requirement, which gets us through any long holiday weekends and such. And it was quite an innovation. And it caused now a very sort of traditional equity investment to really permeate the short-term fixed income trading desks. So anyway, to keep it as brief as I could, I thought I did a pretty good job. Now next month. Might seem like tomorrow to you, but I tell you, I hope we don't have 1.5 feet of snow behind me when we see next month. But next month, we're going to be talking about the bond market, which is where I came from. I came to age on Wall Street in the heyday of the bond market. When I got my job on Wall Street, I couldn't have put a gun in your mouth and got you to buy stocks. Bonds are what ruled Wall Street, and Salomon Brothers was king of the bond market. So we're going to get the basic premise of what the bond market's all about, why do people invest in bonds, and so on. We'll start that next month. So I hope you've all been well. Again, I hope this is the last snow sport kind of video commentary, and I'll see you in about a month.